when you look at the secular trends in the financial industry over the last decade, I mean, the overarching narrative has been pretty bleak for legacy active managers.
Oh yeah, completely bleak.
Right. Like the story we've all been told is that low-cost passive index funds are just, eating the world.
Yeah, that fee compression is this unstoppable force of nature.
Exactly. And the old school mutual fund giants are basically, well, they're supposed to be the Walking Dead, right?
Right. The consensus view on Wall Street has always been that they're supposed to be slowly bleeding assets until they either consolidate or just fade into total irrelevance.
Because the assumption is that if you have this massive entrenched infrastructure built around mutual funds, you are highly vulnerable to the new wave of agile financial technology.
Yeah, that's a standard textbook narrative.
But then you look at a traditional behemoth like Franklin Resources operating under the ticker BNN, by the way, and that whole narrative just completely fractures.
It really does. Yeah, it shatters it.
So welcome to a special Talk Tickers edition of our Deep Dive.
Glad to be here for this one.
Yeah, for those of you tuning in, the mission today is to rapidly, and I mean aggressively, unpack the Q3 2026 earnings call for Franklin Resources.
And we are staying true to the Talk Tickers format today.
Always. Data forward, translating the jargon into plain language, and offering a highly opinionated take on what these numbers actually mean for the stock.
Because we want to figure out how a firm that should, by all traditional metrics, be struggling with this market evolution is instead posting record highs.
Right. It's just a fascinating case study in corporate adaptation.
Truly. I mean, they haven't just managed to tread water. They are actively rewriting their own operational DNA.
Yeah, they're leveraging everything from quantitative tax algorithms to artificial intelligence, and as we'll get into later, some surprisingly aggressive moves in blockchain infrastructure.
Which is wild for a legacy firm.
So wild. So let's start by looking at the raw data they just dropped, because the headline numbers are, honestly, they're legitimately staggering.
Oh, they blew past expectations.
We need to talk about their assets under management first. So AUM just hit a record $1.8 trillion.
Trillion, with a T.
Right. And honestly, a number that large just starts to lose its meaning. To contextualize it for you, we're talking about a pool of capital that is larger than the GDP of entire industrialized nations.
It's massive.
But what stands out to me isn't just the total size, it's the velocity of the capital flowing into the system right now.
Well, yeah, because the total aggregate size is a lagging indicator. I mean, it just tells you what they've built over the last several decades.
Right, it's historical.
Exactly. The flows, however, are your leading indicator. The flows tell you what institutional allocators and retail wealth managers think about the firm today, right now.
And those flows were massive this quarter. They posted $18.4 billion in long-term net inflows just for this third quarter.
That is a huge influx of cash.
It is. It pushes their fiscal year-to-date total to $63.3 billion in long-term net inflows. But I want to pause on the internal breakdown of those flows because there is a statistical anomaly here that feels almost impossible given the current macro environment.
Oh, I know exactly what you're going to say.
They reported positive net flows across every single asset class and every single geography.
Yeah, that is the data point that should make anyone analyzing this stock sit up and pay attention immediately.
I mean, it defies basic market logic.
It really does.
Usually asset management is a seesaw. You know, like if the macro environment is signaling a recession, money floods into fixed income and bleeds out of equities.
Right. Risk-off behavior.
Right. Or if we have a massive tech rally in the U.S., maybe emerging markets suffer outflows.
Exactly. It's always sloshing back and forth.
But to see positive net inflows in U.S. large cap equity, international equity, municipal bonds, multi-sector fixed income, and alternative assets all simultaneously across the Americas, EMEA, and Asia Pacific is just wild.
Yeah.
So how rare is this kind of broad-based synchronized momentum?
It is exceptionally rare. And honestly, it speaks to a structural shift in how large clients are buying financial products today.
Okay. Unpack that a bit.
So you mentioned the seesaw effect, and that's perfectly accurate for how capital usually behaves. Yeah. Money sloshes from risk on to risk off. But when an asset manager captures inflows across every single category, regardless of the macro conditions,
right,
it tells you that the growth isn't being driven by market beta. It's not just that they have one hot tech fund masking outflows everywhere else.
So what is driving it, if not just strong performance in one specific area?
Well, it's this phenomenon called vendor consolidation.
Okay.
If you look at the major wealth management platforms, the massive wirehouses and the global private banks, they're actively trying to shrink the number of asset managers they do business with.
Really? Why shrink it?
Because it is an administrative nightmare for a bank to maintain due diligence, compliance, and technological integration with like 200 different boutique asset managers.
Oh, yeah, that makes sense. The paperwork alone must be insane.
It's brutal.
Yeah.
So they want to cut that list down to maybe 20 or 30 core strategic partners.
I see. They want a one-stop shop.
Exactly.
They want a firm that can provide the municipal bonds for their tax-sensitive clients, the aggressive private equity for their high net worth clients, and the international equities for diversification, all under one roof.
That's the exact dynamic at play here. So when a firm reaches that $1.8 trillion mark and has a menu as diverse as Franklin Templeton's, they become one of those surviving strategic partners.
They make the cut.
Right. The wealth platforms are literally sweeping assets away from the smaller niche players and consolidating them onto platforms like Franklin's.
So that broad-based inflow across every geography and asset class is basically just the mechanical result of Franklin winning that vendor consolidation war.
Yes. It's a structural victory, not just a cyclical one.
Okay. And that structural advantage translates directly into the top and bottom lines.
Oh, big time.
Let's look at the revenue and profit figures. Adjusted operating income sales volume hit $508.9 million.
Which is fantastic.
Yeah, that's a 7% bump from the prior quarter, but more importantly, it is a 35% spike compared to the same quarter a year ago.
That's huge.
A 35% jump in operating income for a legacy financial firm is just massive.
And that jump really highlights the beauty of operating leverage in this specific business model.
Operating leverage, explain how that works here for the listener.
Sure. So the infrastructure required to manage $1.5 trillion isn't actually vastly different from the infrastructure required to manage $1.8 trillion.
Right.
You don't need to double your compliance department or lease twice as much office space to absorb an extra $18 billion in a single quarter.
The pipe's already built.
The fixed costs are already covered. So when that new wave of capital comes into the system, the management fees generated by those assets drop almost entirely straight to the bottom line. That's why you see revenue growth disproportionately accelerating operating income.
Which brings us to the most actionable question for anyone holding the stock. What is management doing with all that newly generated cash?
That is the big question.
Yeah, and they reported $521.5 million returned to shareholders this quarter, and the bulk of that $348.1 million was deployed in share repurchases.
That's a lot of buybacks.
Right. Now, share buybacks are standard practice, sure, but the context management provided on the call was highly specific, and I really want to dissect it.
Yeah, it was an interesting move.
They stated they opportunistically bought out a 1% overhang from Great-West Life, which was a byproduct of the Putnam acquisition.
Right.
Let's break down the mechanics of this for the listener. What exactly is an overhang, and why does clearing it matter so much to the stock's performance?
Okay, so this is a textbook example of aggressive defensive capital management.
Defensive? How so?
Well, to understand the overhang, we have to rewind to when Franklin acquired Putnam Investments. In that transaction, a company called Great-West Life was involved.
Okay.
And as part of the deal structuring, Great-West Life ended up taking a 4.9% strategic equity stake in Franklin Resources. It was a lockup agreement. However, Great-West Life communicated clearly to the broader market that if they received any shares of Franklin that pushed them over that 4.9% threshold, they were going to liquidate them.
Okay, so every institutional trader on Wall Street knew there was this massive block of shares just sitting there waiting to be dumped on the open market.
Exactly. And that is the strict definition of a stock overhang.
It just hangs over the price.
Right. It acts as an artificial ceiling on a stock's price. Even if the underlying business is performing beautifully, buyers are hesitant to bid the stock up.
Because they know there is a massive wave of supply poised to hit the market the moment the price rises.
Precisely.
Yeah.
It creates a tremendous amount of friction for everyday retail shareholders.
So instead of letting Great-West Life slowly bleed those shares out over months, which would have created this constant downward pressure on the stock, Franklin's management stepped in and bought the entire block directly.
Yes, they used their own fortress balance sheet to absorb the selling pressure instantly. They essentially contained the blast radius of that transaction.
That's a great way to put it.
And it's worth noting, management specifically pointed out on the call that they had recently resolved some legacy regulatory issues with one of their subsidiaries, Western Asset.
Oh, right.
And because that issue was resolved, they were officially out of their blackout period.
Meaning they were legally cleared to trade their own stock again?
Right. And the moment that window opened, they didn't hesitate. They deployed hundreds of millions of dollars to clear that 1% overhang in one swift move.
Which sends a very strong signal to the market.
Huge signal. It says management believes the stock is fundamentally undervalued and they're willing to aggressively defend the share price.
I just love that level of surgical precision from a management team.
Me too.
So to sort of synthesize the headline data, assets are at record highs. The distribution engines are capturing flows globally, regardless of the macro environment. Operating leverage is driving a 35% spike in income, and they are using that cash to actively defend the stock price.
Yep, the optics are incredibly strong.
But, a single strong quarter is just a snapshot in time. If we want to understand if this trajectory is actually sustainable, we need to look under the hood.
Absolutely.
We need to figure out the operational story driving these numbers. And this is where the comparison to a nimble tech startup really starts to take shape, because this growth isn't coming from traditional old school mutual funds.
Not at all. If you look at the core drivers of this growth, they are entirely based on modernized technology forward platforms.
Let's start with a piece of technology they own called Canvas.
Oh, this is fascinating.
When Franklin acquired this platform a few years ago, it had roughly $2 billion in assets under management. On this current earnings call, they revealed Canvas has exploded to a record $30.3 billion.
That growth curve is just nuts.
And they onboarded 26 new massive wealth management partners this quarter alone, bringing their total network to 220 partners.
Incredible adoption rate.
Now, I have to play the skeptic here for a minute.
Good.
On the call, management was throwing around terms like tax overlay and direct indexing.
Sure.
To a lot of retail investors, that sounds like pure Wall Street marketing jargon, buzzwords designed in a lab to justify charging a premium fee.
Yeah, I hear you.
What does the Canvas platform actually do for a client, mechanically, that justifies growing from $2 to $30 billion in such a short window?
It's a totally fair challenge because the industry is notorious for dressing up old products with new buzzwords.
Exactly.
But Canvas represents a legitimate structural upgrade in how individual portfolios are managed. To understand the value proposition, you really have to look at the flaw of the traditional mutual fund.
Okay, let's walk through it.
Historically, if you wanted diversified exposure to the S&P 500, you bought a mutual fund. But you were buying a pre-packaged pool of assets. You had absolutely zero control over the internal tax consequences.
Right.
If the portfolio manager decided to sell a massive position in Apple for a huge gain, that capital gains tax liability was passed down to you, the individual shareholder, at the end of the year.
Even if your own personal portfolio was down for the year. The dreaded phantom tax bomb, it is incredibly frustrating for investors.
It is highly inefficient. Canvas solves this through direct indexing.
Okay.
Instead of buying a pooled mutual fund wrapper, the Canvas software goes out and buys the individual stocks that make up the index directly in your own personal brokerage account. You physically own the 500 individual stocks.
Okay, but managing 500 individual stocks sounds like an administrative nightmare.
For a human, it is. But Canvas is essentially an algorithmic robotic accountant.
Okay.
This brings us to the tax overlay component you mentioned. Every single day, the Canvas algorithm scans your specific portfolio of 500 stocks.
Daily.
If the broader market is up, but 40 specific stocks in your basket are down, the software automatically sells those 40 losing stocks to capture the tax loss.
Oh, wow.
It then immediately buys 40 highly correlated, nearly identical stocks so that your overall investment strategy and market exposure never actually changes.
So it's harvesting those tax losses constantly in the background to offset any capital gains you might have elsewhere in your financial life.
Yes. It operates entirely on autopilot, generating quantifiable tax alpha for the client.
That is so cool.
But the utility goes even deeper than basic tax loss harvesting. They highlighted on the call how Canvas handles concentrated stock positions, which is a massive pain point for high net worth individuals.
Okay, let's walk through a practical example of that for the listener.
Sure.
Let's say you have a tech executive, we'll call her Sarah.
Okay, Sarah.
She's worked at a major tech firm for 10 years, and she's been compensated heavily in restricted stock units. Now, 80% of her entire net worth is tied up in a single highly volatile tech stock.
Classic scenario.
She knows she needs to diversify, but if she just sells that massive block of stock on the open market, she is going to trigger a catastrophic 7-figure capital gains tax bill.
It would be devastating.
So how does Canvas actually help Sarah?
This is exactly the scenario where Canvas proves its worth to financial advisors. The traditional way to handle Sarah's problem would involve incredibly complex manual spreadsheet work by an advisor, slowly selling tranches of stock over years.
It's just a total headache.
Right. With Canvas, the advisor utilizes an in-kind transfer. They take Sarah's physical shares of that single tech stock and transfer them directly into the Canvas algorithmic system without selling them.
Wait, so there's no taxable event triggered upon entry?
None at all.
Wow, that's huge.
Right. Once the concentrated stock is inside the system, the advisor sets the parameters. They tell Canvas, we want to slowly diversify Sarah out of this single stock and into a broad S&P 500 index.
And then the machine takes over.
The algorithm takes over completely. Over the coming months and years, Canvas looks for moments of volatility. It uses the tax losses harvested from the rest of the 500 stocks in the index to offset the gains from slowly, methodically selling off pieces of Sarah's concentrated tech stock.
That is brilliant.
It mathematically unwinds her concentrated risk while completely neutralizing the tax impact.
That is incredibly sophisticated. I mean, I can entirely see why wealth advisors are rushing to adopt this.
It's a no-brainer for them.
If you are a financial advisor, you are constantly trying to justify your 1% advisory fee to your clients.
Constantly.
If you can plug your clients' money into Canvas and hand them a report at the end of the year showing you saved them like $40,000 in taxes algorithmically, your fee justifies itself. You look like a genius, and the software did all the heavy lifting.
That is the core adoption driver right there. The entire wealth management industry is migrating from the old commission-based broker model where they got paid per trade to a fee-based fiduciary model.
Right.
And to get clients to agree to a flat fee, advisors need to offer tangible value beyond just picking stocks. Algorithmic tax optimization is the ultimate value add.
And it gets even more interesting from a business strategy perspective.
Oh, definitely.
On the call, Franklin's management discussed how they are now white labeling this technology. They launched a preferred partner program.
Yeah, I saw that.
This means that competing asset managers firms running their own active equity strategies are knocking on Franklin's door, asking to use the Canvas tax overlay engine on top of their own products.
They are essentially renting out their robotic accountant to their competitors.
It is a brilliant pivot. They have taken a proprietary piece of technology and turned it into a software-as-a-service revenue model embedded inside a traditional asset management firm.
That SaaS-like revenue stream is a huge component of the bullish thesis for this stock.
Absolutely. But Canvas isn't the only engine driving this shift. Let's pivot to the second major growth story they outlined. Private markets for retail investors.
A massive trend right now.
Their alternative assets under management, commonly referred to as alts, hit a record $294 billion.
Huge number.
Now, for you listening, when we talk about private markets, we are talking about asset classes that do not trade on public stock exchanges like the NYSE or NASDAQ. This includes private equity, private credit, real estate, and venture capital.
And traditionally, these were highly exclusive velvet rope asset classes.
Oh, totally inaccessible.
Right. If you wanted to invest in a top-tier private equity buyout fund, you needed to be a sovereign wealth fund, a massive corporate pension, or a billionaire family office.
The minimum check size was frequently in the tens of millions of dollars.
Yeah. Furthermore, the capital was locked up for 10 years. You couldn't touch it.
But the entire structural tectonic plate of finance is shifting right now toward the democratization of alternatives.
That's the buzzword.
Every major asset manager on earth is scrambling to figure out how to package these illiquid private investments so that the affluent retail investor, the dentist in Ohio, the lawyer in Texas, can buy them through their financial advisor.
It is the absolute holy grail of modern asset management because the margins on alternative products are significantly higher than on public mutual funds.
And based on the earnings data, Franklin Templeton is executing this transition exceptionally well.
They really are.
They reported that the wealth management channel, which is the network of financial advisors selling to retail clients, now accounts for a massive 20% of their total private market fundraising for the year.
20% is a huge chunk.
They pulled in $3 billion just through the wealth channel this quarter alone.
The raw dollar amount is impressive, for sure. But what is truly fascinating is the operational reality of how they are raising that money.
Yeah.
On the call, CEO Jenny Johnson used a phrase that perfectly captures the dynamic. She described the process of selling private markets to retail wealth advisors as hand-to-hand combat.
Let's dig into that phrasing because, why is it hand-to-hand combat? Selling a mutual fund isn't hand-to-hand combat. It's just getting it listed on a brokerage platform.
Right.
Why is private equity so different?
Because the friction involved in the transaction is astronomically higher. You cannot simply list a private credit fund on a digital exchange and wait for retail investors to click a buy button.
Right.
Private markets are inherently complex. The liquidity provisions are restricted. Maybe you can only take your money out once a quarter, and even then, it's capped.
Yeah, that's a tough sell.
The fee structures are tiered with performance hurdles. The tax reporting doesn't come on a standard 1099 form. It often involves complex K-1 schedules that delay tax filings.
So an advisor can't just casually toss this into a client's portfolio. They have to deeply understand it to explain all these drawbacks to the client.
Precisely. And to get the advisor comfortable enough to do that, your sales team have to engage in that hand-to-hand combat.
Walk us through what that actually looks like.
Well, first, your firm has to endure a grueling, months-long due diligence process just to get approved by the wirehouse's home office.
Just to get in the door.
Right. Then, your actual human wholesalers have to travel the country. They have to walk into physical branch offices, sit down with individual financial advisors, buy them lunch, and systematically educate them on how a private credit vehicle functions.
Oh, man.
They have to explain why it offers a yield premium over public bonds and exactly how it fits into a 60-40 portfolio construction.
Mm-hmm.
It is a highly manual, relationship-driven, exhausting sales process.
And this is exactly where Franklin Templeton's legacy status flips from being a liability to an impenetrable competitive moat.
That is the key insight. If you are a boutique private equity firm in New York that has historically only dealt with 20 institutional pension funds, and you suddenly decide you want to sell to retail advisors, you are going to hit a brick wall.
Oh, yeah.
You do not have the army of wholesalers required to fight that ground war. You don't have the Rolodex.
But Franklin has been cultivating relationships with these exact financial advisors for 50 years.
Exactly. They have thousands of distribution professionals operating globally.
Right.
They are taking their legacy, traditional mutual fund distribution pipes, the network they've spent half a century building, and they are now pumping these highly lucrative next-generation alternative products through those same pipes.
It is a massive structural advantage that a new fintech startup simply cannot replicate overnight.
No way. It takes decades to build that trust.
And they mentioned specifically that their evergreen platform grew to $8.9 billion in AUM. These evergreen structures are vital for this retail push, right?
Oh, absolutely vital.
Because they eliminate that dreaded 10-year lockup period. They are designing secondary private equity and private credit funds specifically with periodic liquidity windows, making them palatable for individuals who might need access to their cash.
That product innovation is critical. You have to adapt the institutional asset class to fit the retail wrapper.
Speaking of wrappers, that brings us to the third narrative driver they discussed. Active ETFs.
Another huge shift.
The ETF wrapper transition is huge. They reported reaching $75.6 billion in AUM in their ETF business. But the standout metric was that actively managed strategies made up 61% of their net ETF flows.
This data point is so important. It completely debunks a long-held myth in the financial media.
What myth is that?
For the last decade, we've been told that active management is dead and that everyone only wants passive index funds.
Right, the whole active versus passive debate.
The reality is far more nuanced. Investors didn't necessarily hate active management, where a professional portfolio manager is actually analyzing companies and trying to outperform the market.
Okay.
What investors hated was the mutual fund wrapper that active management was trapped inside.
Right. They hated the high fees, the end-of-day trading execution, and, as we discussed earlier, the terrible tax inefficiency of the mutual fund structure.
So when the SEC rules evolved to allow for active management inside the highly efficient intraday tradable ETF wrapper, it was a total game changer. Franklin is simply taking their highest conviction active strategies, tearing off the old mutual fund label and repackaging them inside the modern ETF structure that clients demand.
So capturing 61% of flows in active strategies proves that there is still massive appetite for professional stock picking, provided the delivery mechanism is modernized.
Exactly.
It's the packaging. It's like discovering that consumers still love the taste of a specific soda. They're just tired of buying it in heavy, breakable glass bottles. You start canning it in lightweight aluminum, and sales suddenly skyrocket. The product inside didn't change, but the delivery mechanism removed all the friction.
It's a very clean way to visualize it.
Yeah.
But if we want to talk about removing friction, we have to address the most forward-looking, futuristic element of this earnings call.
Oh, yes.
The artificial intelligence ROI.
Yes. We have to scrutinize this because right now, every single CEO in the S&P 500 is forcefully injecting the letters A and I into their earnings scripts to artificially inflate their stock multiples.
Yeah, it's exhausting.
It often feels like vaporware. But Franklin Templeton brought actual quantifiable receipts to this call.
They did.
They detailed a partnership with Microsoft to build something called the Intelligence Hub. And they aren't just talking about future potential. They reported that this hub has already generated a 25% increase in client visits and a proven 11% uplift in actual closed sales.
That is a staggering metric.
Yeah. No, I need you to explain the mechanics of this. How does a software partnership with Microsoft translate into human salespeople closing 11% more deals in the real world?
This is where we separate the speculative AI hype from hard revenue-generating enterprise application.
Okay.
To understand the 11% uplift, let's go back to that hand-to-hand combat scenario. You have a wholesaler whose territory is the entire state of Texas.
Huge territory.
There are thousands of financial advisors in Texas. When that wholesaler sits down at their desk on a Monday morning, how do they decide which 10 advisors to call that day?
Historically, I assume it's a mix of intuition, looking at who bought from them last month, or just, blindly throwing darts at a CRM database.
It's largely guesswork. Maybe they sort their CRM by last contact to date and start dialing. It is highly inefficient.
Right.
The Intelligence Hub replaces that guesswork with predictive targeting. It is a suite of AI agents that ingest an unfathomable amount of data points.
Like?
It looks at the macroeconomic environment, say inflation is ticking up. It looks at the historical buying patterns of every advisor in Texas. It analyzes the broader firm's research portal to see which specific articles those advisors have been clicking on in the last 48 hours.
So it's tracking digital footprints to gauge intent.
Exactly. The AI processes all of this and acts as a hyper-intelligent predictive assistant. On Monday morning, it doesn't just give the wholesaler a list of names. It provides a next best action prompt.
Okay.
It tells the salesperson, call advisor John Smith in Austin today. Do not pitch him large cap equities. Our data indicates his clients are currently highly sensitive to tax rates, and he spent 10 minutes reading our white paper on municipal yields yesterday. Pitch him our tax-free municipal bond fund.
It is entirely removing the cold call friction. It's serving up warm leads with the exact product recommendation tailored to that specific advisor's immediate real-time problem.
It ensures that the sales force is having a right conversation with the right client at the exact right moment. When you deploy that level of predictive optimization across a global sales force of thousands of people, a 25% increase in effective client contacts and an 11% bump in closed sales makes perfect mechanical sense.
It really does.
And the management team noted that this isn't a pilot program. This is a maturing system, and they expect that sales alpha to continue compounding as the AI ingests more behavioral data.
But the AI deployment doesn't stop at the sales level. They also detailed massive internal operational efficiencies. They reported having over 1,000 internal AI agents currently operating.
1,000.
Yeah. They mentioned AI is actively writing internal code, which is standard for enterprise tech now, I guess. But the one that caught my eye was AI processing due diligence RFPs.
Oh, yes.
For you listeners who haven't worked in institutional finance, you have to understand the nightmare that is an RFP, a request for proposal.
It is arguably the most soul-crushing administrative bottleneck in the entire industry.
Truly. When a massive state pension fund decides they want to allocate $500 million to a new bond manager, they don't just hand over a check. They send out an RFP to 10 different asset managers.
Right.
This document is often a 300-question Excel spreadsheet asking for excruciating detail on everything from the portfolio manager's 10-year track record, to the firm's cybersecurity protocols, to their ESG voting history, to their disaster recovery site locations.
It's endless.
Historically, how is this handled?
Historically, it requires a dedicated team of junior analysts and compliance officers spending 3 straight weeks frantically emailing different departments, digging through archaic internal databases, copy and pasting answers from old documents, and praying they don't make a factual error that triggers a compliance violation.
Sounds awful.
It is incredibly labor-intensive, high-stress, low-margin work.
And now Franklin Templeton is pointing large language models at their own internal data lakes.
Precisely. They have trained the AI AI on every single approved, compliance-vetted document the firm has ever produced. Now, when that 300-question RFP comes in, the AI scans it, retrieves the perfectly accurate, legally approved data from the internal database, and drafts the 300 answers in a matter of minutes. The human analyst simply reviews the output for quality control.
It collapses a 3-week workflow into a 3-hour workflow.
And by eliminating that administrative friction, they are freeing up their highly paid human capital, the analysts, the portfolio managers, to focus on actual cognitive work, like investment research and relationship building.
That's incredible.
And they are pushing the boundaries even further in the R&D space. They mentioned they currently have 3 experimental strategies running in an AI sandbox.
Ooh, right.
One strategy uses AI purely for initial equity research. One uses AI for the actual mathematical portfolio construction. And the third is a fully autonomous AI-driven investment strategy.
Let's just see what happens when we take the humans off the steering wheel entirely. They actually mentioned on the call that they don't even care if those specific AI investment strategies become commercialized products. They are running them purely as a learning exercise to understand the mechanics of autonomous finance. That kind of unconstrained R&D experimentation is the hallmark of a Silicon Valley tech startup, not a $1.8 trillion legacy mutual fund company.
It represents a profound cultural shift at the executive level.
Yeah.
They aren't playing defense, they are aggressively playing offense.
So we've covered the headline data, and we've extensively mapped out the technology and the sales infrastructure that is driving those numbers. Canvas, private markets, active ETFs, and the AI intelligence hub.
We've covered a lot.
But looking backward only gets us so far. We need to know what management is promising for the future. Are these trends decelerating or are they accelerating? We need to analyze their management guidance.
The guidance they provided is where the narrative shifts from being a pleasant surprise to aggressively bullish.
Okay, let's hear it.
Let's look at the revised targets for the alternatives and private markets business.
This was a major headline from the call. At the beginning of the fiscal year, management provided Wall Street with a fundraising target. They said they aimed to raise between $25 and $30 billion in alternative assets for the full year.
Right.
On this call, with an entire quarter still left to go in the fiscal year, they announced they have already raised $33 billion. They completely shattered the high end of their own annual estimate in just 9 months.
And because the momentum in the wealth channel is so strong, they officially revised their year-end target upward to $40 billion.
That is a staggering upward revision. To raise your target by essentially 33% at the 11th hour requires immense internal confidence.
Absolutely.
What underlying data is giving the CFO the confidence to project a $40 billion finish line? Is it just one massive fund carrying the entire weight of the organization?
No, and that is the critical point. If one single mega fund was responsible for all the inflows, the firm would be highly vulnerable to a single point of failure.
Right. If that fund goes down, the whole thing crashes.
If that fund's performance dipped, the whole growth story would collapse. But the CEO specifically detailed the composition of the $10.3 billion they raised in private markets this quarter. It was incredibly diversified.
Walk us through the breakdown.
The largest contributor was Lexington, which is their massive secondary private equity manager. Lexington accounted for roughly 40% of the raise, distributed across 4 different distinct strategies.
Okay.
But it wasn't just Lexington. They saw significant capital inflows into their private credit vehicles. They saw inflows into venture capital.
Wow.
They even saw strong contributions from the real estate platforms, which management noted had been out of favor due to commercial real estate fears, but are finally seeing a resurgence in client demand. In total, capital flowed into 30 different alternative strategies across a firm.
So it's a multi-engine aircraft. If the real estate market hits a sudden slump, the private credit engine is strong enough to keep the plane climbing. If venture capital goes dormant for a cycle, secondary private equity booms to pick up the slack.
Exactly. The diversity of the platform provides a shock absorber for their fundraising pipeline. That structural stability is what allows the executive team to look Wall Street in the eye and comfortably project a $40 billion target.
That makes a lot of sense.
But top-line fundraising is only half the equation. The most critical piece of guidance for a shareholder, the metric that truly dictates the stock's valuation, revolves around profitability and margins.
And this brings me to a major analytical hurdle.
Oh.
There is a mathematical contradiction here that I need you to resolve. We just spent 20 minutes discussing how Franklin Templeton is spending an absolute fortune on infrastructure.
They are?
They are funding a partnership with Microsoft. They are building out over 1,000 internal AI agents. They are expanding the Canvas direct indexing platform. They are paying an army of wholesalers to fight hand-to-hand combat in the wealth channel.
Yes, very expensive.
Yet, despite all this massive capital expenditure, the CFO projected that operating margins will expand to near 30% for Q4 2026, and they officially guided that margins will sit between 29% and 30% for the full year 2027, assuming flat markets.
Right.
How is it physically possible to spend that heavily on next-generation R&D without completely crushing your profit margins in the short term?
It's the paradox of technology scaling. What you are highlighting is the precise mechanism of operating leverage, and it is the holy grail of corporate finance.
Right.
We touched on it briefly earlier, but let's break down exactly how it works in the context of their tech spend.
Please do, because normally heavy tech investment means a multi-year drag on earnings.
That is true during the initial build phase. When you construct a piece of enterprise technology, let's use the AI Intelligence Hub for the sales team as the example. The initial fixed costs are astronomical.
You're just burning cash.
You have to pay Microsoft licensing fees, you have to hire elite software developers, you have to build out the cloud architecture, and you have to train the models. During that build phase, your margins absolutely suffer. You are pouring cash into a black hole with no immediate return.
Right. You are front-loading the expense.
But once the technology is built, tested, and deployed into production, the financial physics of the business change completely.
How so?
The marginal cost to use the software a second time or 1,000th time is effectively zero. The technology begins to scale across the existing network.
So applying that to Franklin's numbers.
Applying it to Franklin. That AI hub is now actively generating an 11% uplift in closed sales. That translates to billions of dollars in new assets and millions in new management fees.
Okay.
But crucially, because the AI is doing the heavy lifting of predictive targeting, Franklin doesn't have to hire 11% more highly compensated wholesalers to capture that revenue. The existing sales force is simply 11% more efficient.
And the same logic applies to the internal AI agents. If the AI is answering those 300-question RFPs in 3 minutes, the firm can process twice as many institutional bids without having to hire an entire new floor of junior analysts in New York.
Exactly. They are successfully decoupling their revenue growth from their headcount growth.
That is the magic trick right there.
In the legacy asset management model, if you wanted to grow AUM by 20%, you generally had to grow your back office headcount by 15% to handle the administrative load.
Right, it was linear.
Now, because the initial tech investments have matured and are paying for themselves through extreme cost savings and productivity spikes, the revenue from that $18.4 billion in new AUM drops straight through the income statement.
Incredible.
The tech debt has been cleared, and the margin expansion is the reward. The CFO actually noted on the call that they are running ahead of their own 5-year internal plan for margin expansion.
It is essentially the Amazon Web Services playbook applied to traditional asset management. You endure the pain of building a massive fixed-cost digital infrastructure, and then you reap the immense high-margin rewards as client volume scales effortlessly across that network.
That's a perfect analogy.
That makes total sense. Let's look at another piece of guidance that speaks directly to their revenue quality: fee stability.
This is a highly scrutinized data point in the current environment.
The CFO provided specific guidance that their effective fee rate, commonly referred to as the EFR, is expected to remain completely stable in the mid to high 37 basis point range.
Right.
Let's translate that for you listeners. That means across their entire $1.8 trillion in assets, they're averaging a fee of roughly 37.7 or 37.8 basis points, or a little under 0.38% per year.
Correct.
Why is management projecting a flat fee rate such a monumental victory in the asset management industry today?
Because for the last 10 to 15 years, the absolute defining terror of the asset management industry has been fee compression.
Fee compression.
As Vanguard and BlackRock popularized passive ETF investing, it ignited a brutal race to the bottom.
Yeah.
If a client can buy the S&P 500 for 3 basis points, it becomes incredibly difficult to justify charging them 80 basis points for a mutual fund. Firms were forced to slash their fees just to stop clients from fleeing.
It was a bloodbath.
Wall Street analysts grew terrified that asset managers would see their revenues continuously shrink, even if their total assets were growing, simply because the price of their product was collapsing towards zero.
It is the ultimate deflationary boogeyman.
For Franklin Templeton to confidently guide that their effective fee rate is stabilized, that the compression has stopped. Means they've successfully insulated their business from that race to the bottom.
So how did they achieve that insulation? Did they just refuse to lower prices?
No, you can't fight the market on price for commodity products. They achieved it through product mix.
Okay, product mix.
They pivoted the massive weight of their organization away from the highly commoditized public equity spaces and toward alternatives, private markets, and hyper-customized solutions like Canvas.
Right. You cannot go to Vanguard and buy access to a top-tier private credit fund yielding 10% for 3 basis points.
Exactly. You cannot get algorithmic, personalized tax loss harvesting on concentrated stock positions for 3 basis points.
Because it's not a commodity.
These are highly complex, premium financial engineering products, and therefore they command a premium fee. Management noted on the call that the blended average fee for their alternative assets is roughly 65 basis points, and some of their specialized private market strategies range well over 100 basis points plus performance fees.
So while the fees on their legacy, passive, or core public funds might still be facing slight downward pressure, the massive influx of capital into these highly lucrative alternative products is counterbalancing it.
Yes.
The heavy weights on the scale are shifting, anchoring the overall blended fee rate and protecting the firm's long-term revenue streams.
They literally engineered their way out of the passive indexing price war.
Okay, there is one more piece of guidance that, while not strictly financial, is highly symbolic of everything we've discussed today.
The name change.
They announced they are officially changing the parent company name. As of August 17th, 2026, Franklin Resources, Inc., will officially become Franklin Templeton, Inc.
Which is long overdue, honestly.
The stock ticker will remain BEN, but the corporate umbrella is finally aligning with the global brand name. Beyond just updating the letterhead, what is the strategic signaling behind this move?
It is the final public combination of their internal One Franklin Templeton strategy. Over the past couple of decades, Franklin has grown immensely through acquisition.
Right. They bought up a lot of shops.
They bought a collection of highly respected, specialized boutique managers, Lexington for secondaries, Brandywine for fixed income, Clearbridge for equities, Western Asset, Putnam.
All big names.
For a long time, these boutiques operated somewhat autonomously in their own silos.
So they kept their own branding, their own sales teams, their own cultures.
But the modern institutional client doesn't want to navigate that kind of fragmented structure. If a massive sovereign wealth fund decides they want to mandate a complex multi-asset credit strategy, they don't want to have 3 separate meetings with 3 different boutique subsidiaries of the same parent company.
No, of course not.
They want an integrated solution. They want one unified investment team that can seamlessly blend public credit, private credit, and municipal debt into a single portfolio.
They want one point of contact, one throat to choke, so to speak, if things go wrong.
Exactly. The name change is a loud, definitive signal sent simultaneously to the global market, to their institutional clients, and internally to their own employees.
What's the message?
The message is, the silos are officially dismantled. We are not a holding company of independent boutiques anymore. We're a single, integrated, unified global organization capable of delivering holistic solutions across the entire spectrum of finance.
It removes the friction of brand confusion and aligns the corporate structure with the vendor consolidation trend we discussed in the beginning. It makes perfect strategic sense.
It absolutely does.
So let's take a step back and look at the whole board. We have dissected the record-breaking headline numbers. We have explored the advanced quantitative technology, the private market distribution moat, and the AI implementations driving those numbers.
We've covered a lot of ground.
We have analyzed the highly confident, margin-expanding future guidance. It is time to synthesize all of this data into a final verdict for the listener. Let's move to the bottom line.
The talk ticker's bottom line.
After aggressively unpacking this Q3 2026 earnings call for Franklin Resources, ticker symbol BEN, we are taking a definitive, unapologetic, highly bullish stance on the stock.
The underlying operational evidence is simply overwhelming.
If you are a listener who is currently holding BEN, or if you are analyzing it for a potential position, the actionable takeaway here is incredibly clear. You need to urgently update your mental model of what this company actually is.
Complete.
If you still view Franklin Templeton as a sleepy, vulnerable, legacy mutual fund dinosaur that is slowly bleeding out while waiting to be disrupted by a Silicon Valley fintech startup, your thesis is fundamentally flawed.
It is entirely outdated.
Yeah.
They are not the prey in this scenario. They have become the predator.
They have transformed into a modernized, highly scalable, tech-enabled platform. They have systematically positioned themselves to capture the two most lucrative megatrends in modern finance. First, the retail adoption of private markets.
Yes.
They took their 50-year-old distribution moat, their entrenched relationships with wealth advisors, and weaponized it to sell high-margin alternative assets to the retail channel faster than the boutique private equity firms can keep up.
And second, the explosion of tax-optimized custom indexing through the Canvas platform, turning a regulatory tax nightmare into an automated value-add software product that they are now renting out to competitors.
The fact that a legacy firm of this size is generating massive net inflows across every geography and asset class, while simultaneously expanding operating margins to 30% through brute force AI efficiency, is an absolute masterclass in corporate execution. We were incredibly bullish on the underlying mechanics of this business.
It is remarkably rare to watch a legacy financial giant pivot this successfully. But there is one final element to this transformation that we haven't touched on yet.
Oh, right.
And frankly, if it plays out the way management thinks it will, it might be the most consequential story of the entire decade.
And that brings us to our final provocative thought for the day. At Talk Tickers, we always want to leave you with a thread to pull on, something to explore on your own that builds on the earnings data but looks over the horizon.
This one is big.
We spent a lot of time discussing their practical AI implementations. But later in the call, CEO Jenny Johnson made a forward-looking claim that honestly stopped me in my tracks.
Yeah, this was wild.
She stated unequivocally and on the record that financial services will be run on the rails of blockchain.
It is a stunning declaration.
Right.
When a crypto founder says that on a podcast, you dismiss it as hype. When the CEO of a $1.8 trillion highly regulated traditional Wall Street asset manager tells her shareholders that blockchain is the inevitable foundational infrastructure of the global financial system, you have to take it seriously.
She isn't just experimenting, she is betting the future architecture of the firm on it.
And it isn't just rhetoric. They are already executing. They discussed a live product called Benji, which is a fully tokenized U.S. government money market fund.
Wait, a live product?
This isn't a pilot program. They currently have $2.4 billion operating in tokenized funds.
Oh.
But the part that is truly wild is the distribution strategy. They recently announced direct integrations and partnerships with major crypto platforms like MoonPay and PayWord, which is the parent company of the Kraken crypto exchange.
Let's analyze the mechanics of this. Why is a conservative legacy asset manager partnering directly with Kraken?
To understand the strategy, you have to look at the structural friction of digital assets. Franklin can build the most efficient tokenized money market fund in the world, but it is completely useless if the end consumer doesn't have a digital wallet to hold the token.
Right. And traditional brokerages, Charles Schwab, Fidelity, traditional bank accounts do not have the infrastructure to hold tokenized blockchain assets natively yet.
They don't. But you know who does have that infrastructure? The crypto exchanges.
Oh.
Kraken, Coinbase, MoonPay. They possess hundreds of millions of fully verified, active digital wallets globally. So Franklin Templeton is completely circumventing the traditional Wall Street brokerage layer.
They are plugging their traditional, safe, yield-bearing financial products directly into the crypto ecosystem's plumbing.
It's a genius arbitrage of infrastructure.
Yeah.
If you are a crypto trader sitting on $1 million in USDC stablecoins, historically, that money just sits there earning 0% interest while you wait for a trading opportunity.
Right. Dead money.
Now, because of this partnership, you can seamlessly flip those static stablecoins into Franklin's tokenized money market fund right there on the exchange. You start earning a 5% yield backed by U.S. Treasuries, and you never had to move your money back to a traditional bank.
Franklin is effectively capturing deposits without ever utilizing the banking system.
It raises a profound question about the future of financial intermediation. And it is the thought we want to leave you with today. We talked earlier about how the old mutual fund wrapper is dying, being steadily replaced by the more efficient ETF wrapper.
Right.
But if you extrapolate Jenny Johnson's vision to its logical conclusion, what happens to the global financial landscape when the ETF wrapper itself becomes obsolete?
What happens when the underlying plumbing of the entire market upgrades?
Consider this. The current financial system operates on a patchwork of archaic databases. When you buy a stock, it takes days to settle through the DTCC and various clearinghouses. It requires armies of reconcilers to make sure the ledgers match.
It's so outdated.
On the earnings call, the CEO noted that when the SEC required them to run their tokenized fund in parallel with a traditional legacy system, they were astonished by the results. The programming language of tokenization smart contracts on a blockchain is vastly more efficient at record-keeping, compliance, and instant T0 settlement than anything Wall Street currently uses.
So here's the provocative thought to ponder. What if Franklin Templeton isn't just launching a neat crypto side project? If a legacy behemoth succeeds in putting traditional stock portfolios, active management strategies, and treasury funds directly onto public blockchain ledgers, they aren't just selling mutual funds anymore.
No.
They are quietly building the replacement for the entire traditional banking, clearing, and brokerage infrastructure.
They are recognizing that the rails of finance are being fundamentally rewritten, and they are positioning themselves to own the new tracks, rather than just paying a toll to ride as a passenger on the old ones.
It radically changes how you value the company. We started this deep dive talking about the cliche of legacy firms being like massive, lumbering cargo ships, slow, unresponsive, destined to be outmaneuvered.
Yeah.
But as we've unpacked the data, the technology, and the vision, it turns out Franklin Templeton isn't just steering the ship effectively. They are down in the engine room, quietly ripping out the old diesel engine and rewiring the vessel for hyperdrive. They aren't waiting for the future to disrupt them. They are actively building the disruption themselves.
It is a remarkable evolution, and the fundamental data proves that the strategy is working.
Thank you for joining us for this special Talk Tickers edition of the Deep Dive. Keep your eyes on the rails, keep analyzing the data, and we will see you next time.